Did you know that some currencies are pegged to the dollar? That means these are fixed rate currencies whose movement does not change at all during the course of a trading day. In fact, for months together, the currency remains the same. Hello, everybody, welcome to this YouTube channel. I'm your learning partner, Sushila Hariharan. If you're interested in a career in global financial markets, investment banking operations, trade life cycle, and the regulations of capital markets, do subscribe to my YouTube channel where we provide content centric, research focused videos on these topics. So let's understand this. We know that foreign exchange is needed in every country in the world which is truly global due to the fact that there is exports, imports, and trading between different countries. Then why do some currencies have a fixed rate mechanism whereas others have a floating rate mechanism? Let's deep dive into this concept. There are very few currencies in the world which are truly floating in nature. So, what is the meaning of floating rate currency? Floating rate currency is a currency where the value of the domestic currency is not fixed to the dollar, but it depends upon the demand and supply of the USD vis-a-vis the domestic currency. In such a market, the market forces of demand and supply for the USD determine the rate of the local currency vis-a-vis the USD. So let's take an example. For example, in the case of USD INR, you know that India is a net importing country. That means we have more USD outflows from the country as opposed to USD inflows into the country. This has been a historic case since the last 7 decades. Then what happens is, because we have so many USD outflows, there's so many billions of USD outflows from the country, the demand for USD is always high in this country. Therefore, in India, we find that the dollar demand normally always exceeds the dollar supply, except if there is a sudden rush of dollar inflows into the country, either by way of FDI investments or investments into capital markets by large pension funds, etc. So in this case, we find that if the demand for USD is exceeding the supply of USD, that means the outflow of USD is more than the inflow of USD, the domestic currency, in this case the INR, is under pressure. Therefore, in our country, in India, the forces of demand for USD and supply of USD influence the exchange rate. The exchange rate today is USD is equal to INR 86, and in the last 4 months it has largely been between USD INR is equal to 80. It went to a peak of almost 86 in the month of February when there was a lot of economic tensions because of the tariff policies announced by the United States government. But over here, you must understand that since the easing of that stress on the tariffs, we find that the demand for dollars has not surged as much as it had on the expectation of tariffs, and therefore the USD INR also went a little below 85. But largely it has been the case that USD INR in the last 6 months has been moving between 80 to 85. But this is the case of floating rate mechanism, and this is largely followed by many countries, including the countries of Western Europe, countries like Asia, in Asia like Japan, India, etc., where the currency is not pegged to the dollar, but it is a floating rate currency, totally driven by factors of demand and supply. The central bank in this case never ever tells you what is the rate. It intervenes in the market if there is a surge, if there is a very strong bullish trend for the USD. In that case, they intervene in the market so as to bring about more rational and sensible prices for the USD INR. On the other hand, there are some countries in the world where their local currency is pegged to the dollar, and the rate of conversion of the USD into that country's domestic currency is determined by the central bank. It is not determined by the forces of demand and supply for USD, and these include a large number of oil exporting countries, of especially countries of the OPEC region or the OPEC cartel. Over here, we find that many of the countries are not willing to allow their currency to be free floating against the dollar, not just because of business and economic interests, but also because of geopolitical factors. In this case, we find that they have decided that this will be the rate at which the USD will be converted into the domestic currency. Such a mechanism is called as a fixed rate currency, and the central bank of the country announces the rate at which the currency will be exchanged for the USD during the course of that day. So, what do FX traders do in these markets? Because there is hardly any scope for speculation, trading, or hedging. In this case, they convert currencies and participate in the much more elaborate currency pair, that is the USD EUR or the USD JPY, which will give them some returns in terms of pip trading. On the other hand, if they are going to convert their USD into local currency or vice versa, then they have to do it at the fixed rate that is determined by the central bank. Many countries of Africa as well as Latin America have chosen the fixed rate as well, because their currency is a little weak and they don't want the currency to deteriorate, devalue, or depreciate rapidly, quickly, swiftly in a short period of time with the USD. That could bring economies to the fall. Therefore, remember, when you're processing FX trades or when you're trading in FX, you might look at a currency pair like the USD AED, that's the currency of the United Arab Emirates, and you might say, oh, it isn't moving at all during the course of a day, it isn't moving at all during the course of a week. Oh dear, it isn't even moved in a month. This is largely because the currency exchange has been predetermined by the central bank of that country, that is United Arab Emirates, and currency can be exchanged from dollar into that or from the home currency into the USD only on the basis of exchange rate as determined by the central bank.